about how much you should invest in the NPS.
So the minimum contribution per year is 1,000. That's all. There is no maximum. You can do as much as you want. So it's very easy to remember the asset classes. ECGA.
Okay.
E is for equity. C is for corporate bond. G is for government securities. And A is for alternate assets. You're allowed to change your fund manager once a year. So if you don't like somebody's fund performance, so if I change my allocation for equity debt, if I change the allocation, I have more debt, less of equity or vice versa, given the fact that the fund management charges are globally the lowest in the world for actively managed funds, if I were Meena.
Hello and welcome back to this very special series on the National Pension System, that is the NPS. Once again, today we have with us Mr. Subhashish Ghosh of Kotak Pension Fund. Thank you so much, sir, for joining us here today.
Thank you for calling me, Sana.
All right. Well, on episode 5, we have an interesting scenario because it basically throws up a difficult choice about how much you should invest in the NPS, right? So, our situation for today is 30-year-old Meena, who I think is at a perfect age now to start thinking about retirement. She wants to start investing, but she's not sure how much to contribute or what returns to expect. So, to help her out, first of all, what's the minimum and maximum contribution into the NPS at any given point in time?
So the minimum contribution per year is 1,000 rupees. That's all. There is no maximum. You can go as much as you want.
Right.
Of course, there's a tax break that is available up to a particular amount. Beyond that, there is no tax break, but it doesn't really matter. I mean, if you can save as much as you want.
Right. And for anyone investing in the NPS, you mentioned that there are managers who sort of deal with these funds, right? So, what asset classes does the NPS invest in? Is it just equity and debt, or is there anything else as well?
Okay. So, it's very easy to remember the asset classes. ECGA.
Okay.
E is for equity. C is for corporate bond.
Okay.
G is for government securities. And A is for alternate assets.
Okay.
In equity, NPS fund managers are allowed to invest in top 200 companies by way of market capitalization.
All right.
So it's kind of a large cap and semi mid cap kind of a stocks which you're allowed to choose. Only the top 200. Then there is a corporate bond where you obviously invest in bonds of highest safety. Government securities is guaranteed by the government as it is. And A is called alternate assets. Alternate assets are basically infrastructure related SPVs that issue bonds, which is REITs and invests. You invest there. There's a particular ratio in which you want to invest, whether it's active choice or auto choice. So there are these 4 classifications. I must tell you that there's no sub-classification beyond this. Right. There's not like in equity, you have this top 200. So there is no mid cap, multi cap, short cap, small cap, all that is not there. Just the top 200, the fund manager chooses how many they will invest. They'll invest in 20, 30, 40, 50. That's their choice based on how the stocks look like from time to time.
So all the schemes managed by the different fund managers would give differing returns, right? Based on how
That's
much
right. There are 10 fund managers and one can choose one fund manager for each asset class, or they can have one fund manager managing all the asset classes.
That is interesting. So you can actually have multiple asset managers in a single NPS.
Oh yes. That's the beauty. Again, that's the beauty of it. So you have 10 fund managers and you have tier 1 and tier 2. Just to repeat, tier 1 is the long-term retirement fund and tier 2 is the short-term need for savings. In tier 1, you have 4 asset classifications, E, C, G and A. You can technically have 4 of them. Okay, actually 3. I'm so sorry. A is the same as your guild. You have 3 fund managers, one for equity, one for corporate debt, and one for government securities, and A is a part of the first 2. In tier 2, again you can have 3 fund managers. There in tier 2, alternate assets is not there. So you have equity, you have corporate bond, and you have government securities. So technically, you can actually have 6 fund managers. Right. 2 for asset, 2 for equity, 2 for corporate bond, and 2 for government securities.
Right, and that I think is something interesting and something that also makes it different from other investment options, because you're literally choosing the person who manages that particular
That's right.
fund for you, and your overall return is based on like a cumulative how well they perform.
Yeah. And I'll tell you one more thing. There are two more points I need to mention here. You're allowed to change your fund manager once a year. So if you don't like somebody's fund performance, you can change that fund manager next year. Number one. Number two, any inter-fund transfers, there is no taxation in it. So if I change my allocation for equity debt, if I change the allocation, I have more debt, less of equity, or vice versa, there is absolutely no charges. Number one, there is absolutely no tax loss also. There's no taxation element. You don't have to pay any tax because no units are being redeemed. You're moving within the NPS structure. So there are two additional very powerful elements that you are having.
Those are powerful because that again differentiates it from mutual funds, wherein you would have to pay a certain amount of exit load.
See, actually, I wouldn't want to compare with mutual fund for the simple reason I strongly believe that people should invest in various asset classes as per the needs. So I think you require mutual fund, you will definitely require NPS. You also require bank savings. You also require to invest money in other sources. So diversification is required. How you should diversify is very much dependent on your need. So honestly speaking, you should have mutual fund. You also should have NPS.
Balanced asset allocation, and NPS is an important part of that.
Should be an integral part of your retirement plan for sure.
Right. So I think it can also get tricky now that there are so many options for people to, be able to manage, and not everybody may have the time or the bandwidth to be able to, research on who you think your fund manager should be, etc., where exactly how much you should invest. So is there any option of like just investing like on an auto basis versus, keep on telling them how much to put where?
So let me put it in a way that should give you a lot of comfort. See, the fund management of all the fund managers, and there are 10 of them, is very tightly monitored, both by PFRD, who's a regulatory authority, and under that is NPS Trust. Every quarter, we as a fund manager display our entire portfolio to them, where we actually have a discussion with them and they ask us questions on where you have invested and how you have invested. So there is apart from our internal governance, the regulator is also looking at it all the time. That is point number one. Point number two, these returns are available on the NPS app, which is there. Wherever you have invested, if you are in NPS, congratulations, you've done a great job. So I don't think someone should get very carried away by worrying that, oh my God, my returns are very, very low. In a 7-year, 10-year period, which is available, data available, the returns are not much between any of the fund managers. All of them have performed equally well.
Noted. So what about, someone who may want maybe more control over their accounts? I believe you said that when, you download the app or you log into the portal, you have a choice between active and auto.
That's right.
So what is the difference between these two?
Yeah, good point. So active choice allows you to decide how much equity you want and how much of government securities you want, how much of alternate assets you want, and how much of corporate bond you want within a particular parameter. So in active choice, you can have maximum 75% in equity, you can have 100% in government securities, you can have 100% in corporate bonds, and you can have up to 5% in alternate assets. The choice is yours.
They're being safe.
Yeah, so choice is completely yours, and you can change your allocation 4 times a year, completely free of cost. Completely free of cost. For people who don't know much and don't want to go through this, you have 4 schemes to look at, which is a part of the auto choice. First one is LC 75. LC stands for life cycle. 75 means the maximum equity at the age of 35. Okay. So at the age of 35, you have 75% in equity, and the balance 25% is in corporate bond and government securities. As the age increases from 35 till 55, the equity component keeps coming down, and finally at the age of 55, it reaches 15%, whereas the balance becomes debt. In LC 50, the maximum equity component is 50 from the age of 18 till 35, and thereafter the equity component goes down and reaches 10% by the time the person subscriber is 55 years of age. And the LC 25, which is most conservative, the equity component is only 25% at the time the person is 35 years of age, and then it goes down to 5%. Added to this, the new fund, new offering, I would say, not fund, offering that has been issued by the PFRDA, which is called balanced fund. In balanced fund, you start off at 50% equity, but it continues 50% till the age of 45. And then till the age of 55, your 50% comes down to 35% only. So you have this a much larger equity exposure, a balanced equity exposure for a longer period of time.
Right, right. And I'm presuming this declining equity is because as you grow older, your risk appetite comes
Generally
down.
should be coming down. So therefore they have given you. But if you feel that you understand equity, you can continue in active choice. Choice is completely yours.
Right. So taking into perspective Meena's situation or any other investor like her, what would you advise them to go into actively managed or like auto?
See, if you ask me personally, the only way you can beat inflation over a long period of time is to be in equities. That's how our data has shown. Therefore, in my mind, given the fact that the fund management charges are globally the lowest in the world for actively managed funds, if I were Meena, I would be 75% in equity and only 25% in debt. I would do that. I would advise her that also.
So you would choose out of those 4 auto options, you would choose?
No, I wouldn't choose. I would choose active.
You would choose active.
I'll choose active and I'll put 75% in debt. 75% equity.
And then let the manager take care.
Let the manager take care. You can keep checking your app.
Of course.
Once a year, twice a year, you can keep checking how they are doing. But in the long run, whatever data that is available in India, equity is the one that consistently gives higher returns than debt. Consistently. What you can do is that once you have built up a corpus, by the time you're 55, you may say, okay, now let me protect what I have. So then you may change your allocation to move to even 100% in debt if you want.
Right.
So then that is what you might do. Except if you're in active choice, you are in control. In auto, you're giving it away. But if you have a bent of mind that I don't want to spend too much time, you may do that. You may move into auto choice.
You can just leave it and
you can just leave it and let the fund manager manage. Yes.
Yeah. Okay. So well, since you mentioned these returns, etc., how can one check their return history? It, I'm presuming, is on the app.
It's on the app. You have got the NPS Trust as an app. You just open the app and have a look at that.
And that gets updated on a daily basis, like
Absolutely.
as per market.
Absolutely. End of the day, the NAVs are put over there.
Okay. End of the day, it gets updated. Got it. And how often should one contribute to? Is there a difference in active versus passive? How
No,
often
you can contribute daily if you want.
I need a salary daily to be able to contribute to it daily.
So at least once a month for SIP, I think then you're taking the market ups and downs together. I think SIP is a very good way of investing.
And it doesn't matter whatever you choose, whether passive or actively managed, you can just...
You can choose SIP all through. So you give instructions, to the bank and they will then, keep investing on, put the money, take away the money from your savings account and keep putting the money there.
Well, thank you so much, Mr. Ghosh. I think that was extremely insightful. And for everyone struggling with that choice, how much should you invest? I think on this episode, we've got a very, very clear answer to that. And on further episodes, we're going to delve even deeper into this. So stay tuned.